This is the Twin Cities Real Estate Investing Show. Real stories, real success in Twin Cities real estate. Join your hosts, Adam Tafel and Tim Swierczek, as they dive into the world of Twin Cities real estate investing. Together, they share valuable insights and practical tips to help both new and seasoned investors navigate the Minneapolis-St. Paul market. With a focus on relatable stories from real people, this show will empower you with the knowledge and confidence to thrive in your investing journey. Guys, take it from here.
Hello, Tim.
Hey, Adam. How's it going, buddy?
It's going all right, man. We had a successful meetup last night.
Yeah, I liked it. That was one of my favorite ones to do. I liked it specifically because I think we did something that I haven't seen done before, right? In terms of analyzing a city to the level we analyzed it.
Yeah, so we got this idea to do a investor's tour of the Twin Cities. But we work with a fair amount of out-of-state folks or folks who maybe grew up in the Twin Cities, but they've been in the suburbs all their life, and they want to invest in small multifamily, and they really don't know anything about the cities themselves. So we thought this tour idea would be good, and then yesterday, sitting at the dining room table, we figured out this is way too much for a single meetup or video or anything. So we decided to focus on St. Paul specifically, and we're going to go over some of that today.
Yeah. Before we do that, we should probably tell people this is a podcast we're planning on doing once a month where we don't interview anyone. We're going to go through some market updates, just talk about some stats that we get from transaction coordinators, which does a sampling of transactions across the Twin Cities in a fairly high volume, I mean, more than any one realtor or loan officer or even branch would do, right? It's like more than one office would do. So they give us some nice insights. We're going to do that on every single podcast. We're going to lead with that, and then we'll have a topic, and I'm sure we'll evolve over time, but we're going to guarantee you those two things once a month.
Yeah, so this is just an Adam and Tim episode, and look forward to these monthly. Of course, we'll take your comments and suggestions. If there's something you want to hear Tim and I dig into next month, we'd love to hear it. I think also this is an opportunity for us to share about our personal deals, successes, challenges, things like that.
Yeah.
Because I know people like hearing about that. So let's get into it. What do we have for a market update today, Tim?
Yeah, let's talk about, so again, these are statistics we got from a transaction coordination company, and I'll go through them, and then maybe you can kind of give me your comments on how you think it's relevant and so forth. So first one is about inspections waived. We have 23% of all transactions waive their inspections, and this data is from October 1st to October 31st. What do you think of that?
I can't tell you. Can you pull up last month's by chance so we can?
Oh, yeah, I'd have to find it, so give me a second here.
Yeah, while you're looking for that, I mean, the more inspections waived, the more competitive the market. And right now we are seeing one of the most buyer-friendly markets that we've seen. I work under a brokerage called Bricks Real Estate, and the guys at Bricks are super, super data-focused. And they have something called the Bricks Market Meter that takes a slew of different data points like inventory and amount of showings and days on market and things like that. And they rate it out of 20, I believe. And so a 1 would favor buyers heavily, a 20 would favor sellers. And so I say all this to say that we are right at a 3 out of 20, meaning we are favoring buyers more heavily than we've seen. We haven't seen a market favoring buyers this heavy since December of 2019, according to the guys at Bricks. So anyways, I'd be curious to see if inspections waived is trending up or down.
It's definitely trending up based on their other. So they also send out weekly ones. I'm not seeing one that shows me the whole month of September, but their weekly ones were showing closer to 19%. I saw 19% a couple times. And by the way, they do give me an indication that it's trending up on the report they sent out. So the 23 is somewhere around 4% higher than what it had been trending at. I even think, 19% is basically 1 out of 5. That's more than I expected, really,
Yeah, I'd also be curious to see, like, what if we took, like, spring of 2021, for example? I'd be curious what are we waiving peak sellers market? Maybe it's I bet you it never goes above 50 is my guess.
Okay. But it's always on the hottest ones, right? So, like, that's something to consider too, folks, is like if you're looking at a house that's been on the market for 1, 2, maybe even 3 weeks, much more likely to waive an inspection than if it's been on there 3 months or 2 months or something like that.
Yeah, I would say even anything over 10 days, we're typically not seeing inspections waived. But yeah, definitely correlated in that way. Also, I'm curious, Tim, are they talking about accepted offers or just offers? It's got to be accepted.
Yeah. It's very clear, only fully accepted offers, this data.
Because like a typical situation, you got a hot listing that gets 12 offers. Well, 9 out of the 12 people won't have the cojones to waive their inspection. And then the top 3 offers that they actually consider are all waived.
Sure.
So when I was thinking it never goes above 50%, I was thinking people writing offers. But probably in a hot market, accepted offers could go over 50. So I stand corrected there.
Yeah, and I definitely have nothing more than just like my gut feeling. But my gut feeling is in a hot market, it's a majority of the offers are there's at least one person, right? 1 out of 12 kind of thing, right?
Completely.
Yeah. Okay, so that was the first one that jumped out at me. This one we talk about a lot because I just think people don't realistically feel that. I think you have to really say this every time, but the percentage of offers to list price is at 99.8, meaning that the average price is 99.8% of what it was listed at.
Yeah, and talking about those really seller favored markets, we see a lot of like 101, 102%, where most homes are selling slightly above list price. I don't love this metric in
because
general.
Because it's an average or what?
Yeah, I just don't love it. I don't know what I'm going to do with this 98.8 if I'm a buyer in today's market. Hey, I mean, it tells me that if I'm just entering the market as a new buyer, I shouldn't expect to pay over list. But again, real estate is so situational.
Sure, you're going to pay over list on, well, the top 10% for sure will, right?
Right. So I just don't know what to do with the info, and I feel like it could be misleading to folks.
The longer I do things, the less I like average anyway. I'm more in a median.
Completely.
Here's a good one. This one kind of shocked me, or not shocked me, but I think it's a good one. But seller contribution to our buyer closing costs, 40%. So 4 out of 10 people are getting some of their closing costs paid. And I think a lot of times, I have people tell me this all the time. They say, hey, the seller's paying my closing costs. And that is not exactly true. Typically, it's a set amount, right? They're covering either a dollar figure, like let's say $5,000, or a percentage of the purchase price, but it's not unlimited. And if your insurance is high, or you decide to buy your rate down, or for many other reasons, it's very possible they're only covering a portion of them, not all of them.
Also, it's sort of semantics in the sense that the seller is covering them. I have an agent who I really respect and have worked with for many years who like refuses to use that term, and he calls them buyer financed closing costs.
Oh, sure. That is more accurate.
It's semantics in the same way that like we say that sellers pay the listing agent's commission, right?
Yeah.
Well, the buyer's the one coming with all the money. Who's really paying that commission? You guys don't spend too much time thinking about this because it's pointless, right? But it is, the 40% is interesting because sellers still feel as though they're the ones paying for it. It's coming off their bottom line, so you could easily argue that they are. And 40% is high. I would imagine in a hot market, this number's under 20, probably in the teens. And for most folks who I'm meeting with now, thinking about buying in the winter, I say, hey, if you only got $15,000 in the bank and you're pre-approved up to $350, $400, you're going to be okay because we will be able to find you a home that you love where the seller will cover 3% of the purchase price, which, correct me if I'm wrong, but that should bring their cash to close pretty much down to just down payment, assuming they don't buy down their interest rate.
It's close. I think in most cases it's more than that, but yeah. I mean, because a lot of, insurance and title fees are 1 to 1.5% right now of the purchase price, right? I mean, it's really that insurance is driving that number, but insurance is slightly under 1%, but you throw the title fees on and you're definitely over 1, like to 1.25, 1.5 right there, right?
Yep.
So, I think you're probably So percentages are weird, right? Because the higher the housing price, the lower percentage you need to cover all your closing costs, right? Because a lot of the stuff is a set fee. For example, the appraisal typically costs the same amount on a $400,000 house as it does on a $200,000 house, but it's it's half the amount of the closing costs on the $400,000 is a percentage. So the higher the price, that 4% on a $400,000 house is probably getting to be pretty close to accurate, but on a $350,000, it's not quite there. You know what I mean? So
sure. And folks who are listening, you might not know that conventional lending standards limit the percentage that they will allow to be financed of these closing costs. So 3% is typical for conventional. FHA can go up to 6%. VA probably similar to FHA.
VA is weird because they say 4, but then there's some gray area in there. So it's 4, but they will allow some others. And for conventional, there are a couple different criteria. You don't have to memorize any of this, but it's different if it's an investment property. It's also different if you have at least 10% down. It increases. So it's just a lot of people who are asking for closing costs often don't have more than 10% down. Mm-hmm. So we just say 3, and that's kind of the really accepted amount by the public.
Sure.
But sometimes you can get 6 on a conventional as well.
And sometimes the closing cost is, if it's all the same to the seller, where you could have a price reduction, you could buy the house for 2% under list price, or you could buy for list price and ask for 2% closing costs. Sometimes manipulating that interest rate is more powerful for the buyer than taking a couple grand off the purchase price.
The rough rule of thumb is it's 2 to 1, meaning that if you had to take $10,000 off the price to get the buyer to agree, if you gave them 20, it would be like giving them 5,000 towards their interest rate or whatever. So like the interest rate buy down typically is twice as impactful as a discount. You have to discount twice as much to get the same benefit to the borrower in a payment. Now there are thresholds there, right? Like giving them $1,000 might not do anything to their interest rate. So it's at set intervals, but that's typically true.
Cool. Next stat is 13% of accepted offers are contingent on the sale of the buyer's home. This is a segment of real estate transactions that kind of ceased to exist for a few years, unfortunately, for lots of buyers. So like gap loan funding probably became more popular. You're going to sell your house and move in with your mother-in-law for a couple of months while you find a new home, because ultimately a seller doesn't want to wait for you to sell your home. I don't know where this is trending, but I would assume that 13%, we've been trending up to that over the past 6 months.
Yeah.
I can tell you personally.
It says it's trending down on their thing, but we don't know from when, probably from September.
Yeah, that I'm sure that could be the case, but it's annoying. It's a goof, for a lot of sellers. And so 13%, that's a healthy number. So if you're listening and you'd like a new home, but you need to sell before you can buy, I would say this ain't a bad time to consider doing that.
Mm-hmm. For sure. Here's an interesting question I've been toying with lately. Let's say you're a lender and you can choose between being able to offer people to do cash purchases. So, the buy before you sell type programs where I could
cash
say,
purchases.
Yeah, where they can buy in cash. So there would be no contingency. And your rates were pretty good, but not quite as low. Or you could go with maybe on the lower end of the rate scale, but you don't have that program. What's more important, and to have all the time?
You're asking me whether a lender.
So if a lender could have lower rates,
just in general.
Okay. Or they could have low-ish rates. I mean, like competitive rates, but not the lowest. But they had an exceptional program to do a buyout. I'm wondering because as I look at other companies, what they offer, right? And I know of this case. There's a company out there that has an exceptional cash buyer program where every single offer a person makes can be a cash offer. Even if they're getting financing right now, and even if they don't have to sell, they have it just down pat.
Well, you need to explain more. Can be a cash offer. I'm a seller. What does that mean? It's not contingent on appraisal. It's not contingent on the buyer qualifying for financing in any way. They're pre-underwritten.
Yep.
So it's as strong as a cash offer.
Correct.
And it can be
It
done
actually is a cash offer to the buyer because the mortgage company is buying the house whether the person closes on the loan or not. It's
Okay.
and
what's the timeline?
To close?
Yeah.
I don't know that. Actually, that's a good question. I didn't get that deep into that question.
But then in this hypothetical situation, if I'm an agent and I need to advise my clients on which lender to use and they have no need for this, then don't we just send them to the lender with a better interest rate? I guess that would be my question.
Maybe.
But
But I
if
guess
I
it
have
depends
to-
on service and everything, right? Because
Yeah.
Walmart's the cheapest on everything, but not everyone shops at Walmart, right?
Totally. Totally.
But yeah.
To answer your question, though, I really
think
like
in this case they're mostly they're in the same ballpark for rate, but the other one always beat the lower rate one always beats the company that has that. So that has the whatever the cash for keys or the cash offer program.
Yeah, I guess I like the cash offer program, assuming that the interest rate is
Competitive.
under 5, half a point
Yeah.
more.
Yeah. Just curious. I mean, it's something I came across this company and I was like, they're pretty good. Yeah.
No, and I mean in a spring market where people are offering their firstborn children to get the house, that is the loan offers you want to work with all the time, for sure. Refinance if you end up not liking the rate, because it'll be the difference between getting accepted or not.
Yeah.
4% are using an escalation clause, which basically means we don't have a whole lot of hyper competitive activity, and 6% are using an appraisal gap, also low, also indication of not a ton of multiple offer activity. Now, as far as general...
I was kind of surprised there were any appraisal gaps, really. I mean, because it just doesn't feel like that kind of market. But I suppose you still have hot houses here and there.
I absolutely, if you have a beautiful home that's priced between $350 and $550 in a great area, and you price it right, some people will go bananas for it.
Well, and I'm sure you offer appraisal gaps in situations where you think it's very likely it's going to appraise, and if it doesn't, it's going to be close enough that the person doesn't care, right? So we're not talking about like unlimited appraisal gaps of $100,000 or something. We're talking about like, it should appraise, but you might have to bring in $5,000 to $10,000 additional, right? That kind of situation.
Yep. As far as general numbers from the Board of Realtors.
What about that cancellation rate? Can we talk about that real quick? It's 7%. I mean,
what do we normally see?
It doesn't really jump out at me. It says it's going up, but it doesn't jump out at me. But to me, it feels like more because I see people cancel for inspection reasons more than 7 out of 100. I mean, I didn't do 100 deals last year, and I feel like I had 7 cancel. You know what I mean?
Yeah,
I probably did like 50 deals or less last year, and I feel like I had 7 or 8 cancellations. Maybe 6. I don't know, something like that.
Yeah, I don't know what my personal cancellation rate is, and I can't comment on 7% does feel a little bit low to me. I wonder if we see a higher cancellation rate in a crazier market because someone who is paying $75,000 over list price with an info-only inspection where they can't renegotiate gets cold feet. But anything I would add to that stat would just be me guessing.
Sure. All right.
Board of Realtors numbers. Average days on market are trending upward from 30 to 34. We've been seeing things around the upper 20s to 30s for months. That's not really news. Median sales price continues to, in the Twin Cities region, track upward. And so this is your appreciation number, folks. If you're a real estate investor, median sales price is generally what you want to track. 2.7% year after year. Pending sales have fallen every month in 2024. Realtors out there, you're having a bad year because of this metric. But finally in September, we're trending upwards. So the amount of just sales volume is going down as the year goes on. And finally, we're kind of going up. So
there's a reason rates had dropped then, right? So we had a dip in the market, and that's going to bring on some buyers. Yeah.
Well, speaking of rates, Tim, tell us about the rates.
Well, they had dropped in September. Now they crept back up. I mean, it depends on the loan program you're talking about. The national average has been hovering right around that 7%, with some points in there. I think the national average for the place I look at is at like right around 6.7 this
Okay.
week, like currently. But Freddie Mac has it higher than that, and some other ones. So it really does depend on your situation. But you can think high 6s, low 7s as a owner-occupied type rate, depending on down payment, credit score, all that stuff. So they have one up. No need to panic. I mean, some of this stuff is somewhat expected. They're up even a little bit today, but we know why. Inflation is one of the biggest causes of rates staying where they're at, and the inflation data right now is still not that great. It came in exactly as expected, but what they do is they're comparing this year versus last year. And last year, the replacement number, last year's inflation rate for the month of October, which is what we get now, was very, very low. It was like one of the lowest of the year. We knew that it would be hard to be that low again, and that it wouldn't be that low again. So inflation rate goes up by that metric, or by that, by judging it by that way. So
Also, the stock market's been on a tear since Mr. Trump was elected.
yeah.
Doesn't help things.
Yep, doesn't help things. So, what I'm seeing, I did look at, I looked at Fannie Mae, the Board of Realtors, and Wells Fargo. They all publish reports. Wells Fargo is the most optimistic for rates, the Board of Realtors and Fannie Mae are coming in right about the same. They're all expecting to be in the 5s by the end of next year, but they were talking mid 5s. Now they're talking like high 5s, except for Wells Fargo still thinks mid 5s.
I'm getting deja vu. I feel like I've heard this before. Mid 5s by end of next year.
Yeah.
We heard this last year.
We did, yeah. There's no question it's taken longer than I had expected. But, these companies do have stake in getting this number right because they have to. So you're Wells Fargo and you are upper management. You have to know how many loans are going to refinance when you do a loan today. So if I offer someone a rate of 7% today, how likely are they to keep the loan for, let's say, 3 years? Let's say your break-even point's 18 months. And you're profitable, so you're not profitable till the 19th month. And you have to justify giving this loan at a certain rate. 30 months is like a common mark. How many loans are we going to keep over 30 months? And they will price their loans accordingly based on that. And they have to know, like if they think rates are going to be in the high 5s, that means that today's rates that they offer either have to be lower or people have to pay more points. If they don't pay the points, they're going to lose money, if that makes sense. Because they have to charge more up front so that they can shorten that 18 months down to, let's say, 6 months.
And so all you're responding with to my remembering what I heard last year is that, well, they're doing their best and they're being truthful because
they have to be, or they could lose their job. Yeah.
Understood.
I mean, for them, it's good for it to stay up. They have less risk if they stay up, right? It's just if rates drop and they drop quickly, they can lose millions. I don't even know the number, right? Like they can lose an astronomical amount of money by getting that wrong in the wrong direction. So maybe they do want to be a little optimistic, maybe, but in the end, they have to try to be accurate.
And I've said this before, but I just don't think, I think if you're looking to get into real estate investing or if you are a smaller real estate investor, I think all of this rate talk and speculation is a giant waste of time, and you should spend your brain thinking about other things.
Finding great deals.
Yeah.
Finding great deals and managing them well.
Because if you don't like a duplex at 5.5%, or you don't like a duplex at 7%, I don't think you're going to like it at 5.5% when we're only talking about $400,000 properties. Maybe you like it a little bit more, but I'm sick of hearing about it.
Sure.
So yeah, that's your market update. So we host a meetup, and we do it typically once a month, typically the first Tuesday of the month. You guys can go to meetup.com and search for Twin Cities Real Estate Investing. We also have a Facebook group, and pay attention. A lot of the times our meetups are on location at a property that Tim is flipping, or maybe a rental where I have some vacancy. But last night we did a classroom style meetup where we talked about St. Paul data.
Yeah.
And first, let's just talk about some surprises that we had, and then let's get into like the main takeaways. And we're going to post this spreadsheet in the show notes on TwinCitiesRealEstateInvesting.com.
Yeah, that sounds a good idea. I think we should also talk about the Twin Cities overall, so you can get an idea of the big picture.
Cool.
Right. So big picture, this data is the last 12 months, every single closed transaction on the MLS, and it is the entire Twin Cities metro area, right? So, I mean, you went out to Shakopee, right? And north to Anoka type areas and stuff like that right across. So,
just small multifamily as well.
Small
that
multifamily.
You're about to talk about.
Only 2 to 4 units, 861 total transactions, which is down. I've done this exercise for the last 3 years. This is my 4th time doing it, and it's always been over 1,000. Matter of fact, 1,100 was just kind of normal, just 1,100 transactions. This one's 861, so down considerably. And 2-unit sales, typically they're almost 1,000. 729 duplexes were sold in that area in the last 12 months. The median price of this was $385,000. And that represented 85% of all those sales. So 8.5 out of 10 multifamilies are going to be 2 units. Now 3 units were up a little from my previous. They usually comprise the least by far. They were 65 total transactions. So and then that represented roughly half of the remaining difference. So ballpark number, it's about 7.5% of the market are 3-unit properties. The other 7.5% is 4-unit properties. Those were 67 transactions, so not really that different. Median prices, though, here's what happens. You go from $385 up to $434. So you've got like a $59,000 difference for that extra unit. So I think
Tim's talking about from a duplex to a triplex, right?
From a duplex to a triplex, you got a $59,000 median difference in price. To go from the 3-unit to the 4-unit, it goes from $434 to $599.
Quite a big difference.
Yeah.
So the takeaway there is that maybe you're getting a good per unit value going triplex shopping. However, if you find a triplex you might like, you better get on it because there aren't too many of them to go around.
100%. And the other thing I'd add to all of these numbers, everything we talk about today is these are big market picture to give you a big picture. When you drill in, you still have to look because if the triplex is in crappy condition and it only has 1-bedroom units and it's a wonky setup that has been run by a slumlord and needs a lot of work, it could be an awful transaction, even if it's the same price as the duplex down the street that's in wonderful condition, right? So
Tim and I both agree on something. I believe that we don't love units for the sake of units.
Yes. Especially at this level, right? Yeah.
I had a 5-unit that I was selling last year. 5 units, all 3-bedroom, big 3-bedroom, 1-bath with private laundry in Central. We were asking about $1 million for it. And the feedback I got from most investors is I could get an 8-unit for that. I could get a 10-unit from that. But our financial metrics were better. And so I found myself in a few different emails with investors just throwing it out there is there some intrinsic value in owning more kitchens? I would say that's almost a bad thing. It's just more shit that's going to break.
Mm-hmm. Mm-hmm.
So
at the lower scale that we're talking, unit count is not nearly as important as bedroom count in my eyes.
Totally.
But you'll find here there were some places where bedrooms didn't matter either. So generally speaking, I am in favor of more bedrooms, but there's some limits to that.
And so, to be clear, the market has a built-in value intrinsically for units. If we have a 4-bedroom duplex versus a 4-bedroom triplex, and everything is exactly the same except for one of them as an extra unit, that triplex is going to be worth more. What Tim and I are saying is maybe you want to buy the duplex in that scenario.
Yeah, because you're going to typically have a lower sale price, right? Well, that's what we're saying, right? Because the market will pay more for the extra unit. Yep. You're also typically going to have lower taxes, typically lower insurance, and in many cases, once you go above that 2-bedroom, you end up a lot of times the landlord's paying for more utilities. Not always, but
sure,
kind of common.
Well, let's talk about some main takeaways from St. So what we discovered was we can't do a tour of the whole metro in one episode, one meetup, whatever. We're just talking about St. Paul. Let's pull up the spreadsheet, and I've got a list of main takeaways here.
Yeah. Should we go through the numbers real quick at St. Paul? I'll just kind of rattle off what they are so people know.
Yeah, absolutely.
So St. Paul, there were 267 multi-unit families, 2 through 4 unit properties that sold in that calendar year from that 861 total. It was roughly, I think, about 31% of the market. So 3 out of 10 are happening in St. Paul. The median sale price is $320, in St. Paul for 2 to 4 unit properties. There were that's median, not average. Just so you're aware, the average actually is higher at 359. There's a $1.3 million transaction that probably pulls that up a little bit, right? The low price was 105 and the high price was 1.31. So just to give you an idea.
Just to be clear, now we're going to talk about neighborhood-specific data. The program that we use to scrub the MLS most efficiently for sales data includes single-family homes. So what Tim was just talking about was small multifamily, but now as we're talking about just neighborhood-specific stats, we're talking about the whole real estate market, which in my opinion, it's not ideal, but it's completely, you can bank on this as you're, if you're thinking about investing in small multifamily, definitely listen to these numbers because your duplex is probably appreciating right alongside of the single family next to it at a very similar rate.
Sure, yeah.
So we went through St. Paul neighborhood by neighborhood, the A-class neighborhoods being Highland, Mac Groveland, and Summit Hill. We've got a B-class at Merriam Park, Summit University, Cathedral Hill, West 7th, West Side, Battle Creek. And C-classes being Dayton's Bluff, Payne Phelan, Midway, Como, the Greater East Side. And we had some surprises here and what we're analyzing. And if, maybe pause the podcast and go to TwinCitiesRealEstateInvesting.com and pull up this spreadsheet if you want to be right there with us. But we found the average rents of 1-bedroom, 2-bedroom, 3-bedroom, and 4 bedrooms. We found the average yearly growth in appreciation, meaning how is that median sales price tracking year over year? And that's a 10-year average. We're tracking the current median sales price and then the 12-month amount of duplex sales. So, for example, if you got to be in the Highland School District and you want to buy a duplex, well, you better start offering because you only get 10 a year.
Yeah, and that's one thing that we should mention is some of these were pretty low transaction volume, so they don't necessarily represent that whole neighborhood the way we would like,
But still, the numbers we're using for a lot, like the rental numbers we're using in the spreadsheet and this sales price and growth are the whole market, right? So it's not, if you see 12-month duplex sales at 6 in West 7th, and then you think, well, I can't quite rely on these medians. No, that's not the case. It's a little misleading, and if anyone who works at InfoSparks is listening, we would love a multifamily filter so we can fix this. But folks can look through the whole spreadsheet on their own. Let's just talk about the key takeaways. First of all, Frogtown looks best on the spreadsheet.
Yeah, no doubt about it. It does stand out. Although it's one of the takeaways is it stands out in many ways, but when you really dig in, when you look at price to rent type ratios, it's marginally better than a few other neighborhoods that are typically considered higher quality neighborhoods than Frogtown, that is.
Yeah, so Frogtown's got the best appreciation, 10-year annual growth at 8%.
10-year.
That's the average per year over the past 10 years.
Interesting. Okay. I didn't know it was a 10-year. That's cool. Oh, that's good to know.
Yeah, it was just the most, how could we be more accurate in what people can expect for the next 10 years? However, and so I guess we warn against spreadsheet investing, right? Tim used Memphis for an example. A lot of out-of-state investors are hot on Memphis.
Yeah.
And the spreadsheet itself, although here we are talking about our awesome spreadsheet, there's a lot more to it. And I guess our opinion is if you get 8% appreciation in Frogtown, where your eviction rate is going to be considerably higher, the amount of drama you deal with is going to be considerably higher. I guess I'd take 6.5% appreciation and similar price to rent ratios somewhere else and deal with a tenant class that is maybe just easier on my day-to-day life.
Yeah, I mean, pretty much. So when we dug in as deep as we could and tried to get as granular as we could, the areas that kept coming up over and over again outside of Frogtown were Payne Phelan, West 7th, and the West Side. Those all tended to have similar numbers, and that was duplex, triplex, fourplex. They kind of tended to be similar, and but lower than Frogtown. like by 0.2%. So in terms of cash, in terms of rent to price ratio, that does matter. You'll notice it, but what that's not telling you is how dilapidated those houses are, how many times you're going to not collect rent and have to evict, things of that nature. Now, I don't think that I lived in Palen, and I don't think that most of Palen is incredibly awesome or anything. There's definitely some crime, definitely some eviction type things you're going to need there too. So, the caution is take this data, know where to look, and then still analyze each individual property on its own accord.
Yeah, like looking at the spreadsheet, you might see Mac Groveland. Well, the appreciation is the lowest on the list at close to the lowest at 4.95, and the price to rent ratios aren't great either. So why would you buy there? Well, I would say like the beautiful fourplexes that are the 4-square brick building with like a couple commercial boilers that have been checked every year, and the basement's not getting water, and you had updated electrical, and your tenants have an average credit score of 750.
Yeah.
There's all sorts of reasons to invest in Mac Groveland.
Well, not to mention, so 5% of a $500,000 place is going to generate more wealth for you long term.
Bingo.
Than 7% on a $230,000 place. Anyways, right? So,
good point.
So it's not all about percentages. You spend dollars, you don't spend percentages, and it's levered, right? Assets appreciate at their value, not at how much you put into it.
That's leverage, baby. Let's talk about other key takeaways. I've got written down here: the fourth bedrooms don't always pay especially in the high end areas.
Yeah, that's. I think that was So I'm always a favor of more bedrooms. I promote that pretty heavily. And in two neighborhoods, I mean, it was Summit Hill and Summit University, I believe, were the two neighborhoods where the rents on 4-unit places were slightly lower than the 3-unit. And I mean, we're talking like $25 median rent average rent difference, stuff like that.
Yep.
So these were not major differences, but if it's the same or even slightly higher, $50 higher, and you have to pay, $50,000 to $100,000 more for that bedroom, that's a bad deal.
Totally.
So I guess don't chase bedrooms in those higher end markets. In some of the other markets, maybe you chase them, maybe you don't. Again, it's going to depend on the individual one. But word of caution: the third bedroom definitely pays across the board. It's that fourth one you have to be looking at.
And we're getting this information from Rentometer. You guys can look this up on your own. Recommend getting the Pro account, not a sponsor, but that's where we're pulling all this rental info.
Yeah.
Next key takeaway, we talked about triplex a bit, just a general scarcity in suburban small multifamily. And I've been preaching this for years for clients. You can find I sold a triplex in Plymouth like 4 years ago, and, for $550, and it was probably a break even at the time, but those suburban multifamilies, man, they do not come along. There's a lot of folks that want to live in that type of neighborhood, but they want a house hack. And I don't think that's going to go out of style 10, 20 years from now.
Yeah.
So if you can scoop up suburban multifamily, do it, and maybe perhaps accept, because you're going to get a worse price per rent ratio, and you need to just understand why that is.
And you're going to have to jump on it because, so to put it in perspective, folks, 861 transactions. As a percentage, and I am rounding slightly here, but only slightly, I mean less than 0.5%. Minneapolis is 50% of the market. So it was 49.9 or something like that. And St. Paul was roughly 31% of the market. No other city even hit 2%. So in terms of
total small multifamily sales.
Yeah. So it was 400 and some odd. I don't remember the exact number for Minneapolis. 267 we said for St. Paul. The next closest was Columbia Heights, coming in at 16. So less than 2 per month. Actually, less than 1.5 sales per month in Columbia Heights. And that's third in the whole Twin Cities for transaction volume. It was tied with, I think it was Brooklyn Park.
Sounds about right.
Brooklyn Park, Brooklyn Center, something like that. Mm-hmm. So the point is like, okay, if you want to do Blaine, I think Blaine was like 4 4 to 6 transactions all year. Mm-hmm. And if you want to be in Blaine and you find one you like, you better damn well get it. Mm-hmm. Don't monkey around over $7,000 if that's where you really want to be, because $7,000 is going to be, certainly less than $50 a month. Depends on your rate, but maybe about $42 a month is something like what I might guess that payment difference to be. If you love the place, that's what you got to do.
Yep. Trust your agent. Another takeaway, 2-bedroom units in very high supply within small multifamily. It's the most classic listing. And so perhaps there's something to be said for buying a place with 3 beds. Again, that's where we see probably our biggest jump from 2 to 3, or would it be 1 to 2?
Yeah, and it's across the board. The 3 bedrooms really shined. The rents are still there. They're solid. In some of the communities, I want to see if I can find one that jumps out at me. But I remember, actually, let me look at the rent.
We're looking for the biggest difference between average 2 and 3 by neighborhood in St. Paul. Is that what you're looking at?
Yeah, there's. We had that rental spreadsheet. Let's see here if I can find my copy of it here.
Here's a huge one.
So,
Midway goes from $1,155 to $2,065 from 2 to 3, Tim.
Yeah.
So,
probably
finish that
because
basement in Midway.
People in Midway need it, and there's probably not a lot of them there, right? There's probably a low supply, and it's a demand for 3 bedrooms.
We also inferred that the prevalence of Section 8 in some of these neighborhoods is probably manipulating these numbers a bit. You're taking away the free market and the government gets involved. So that's why we see, the average 1-bed in Frogtown is $1,215, whereas you could go to Summit Hill and it's $1,060.
Well, and here you go. Mac Groveland and Summit Hill both, the difference between a 3-bedroom is significantly higher than the difference between a 1 and a 2. So a 1, I have to round these for the podcast sake, but like Mac Groveland, the difference between a 1 and a 2 is about $500 a month, and it's $700 a month between a 2 and a 3 for the rent for that room. So or that bedroom. So I mean, and that it's not. Gosh. Looking at, I'm just kind of quickly going through the spreadsheet. Those spreads vary, but the 3 beds really do shine, like across the board. So that would be maybe one of the bigger takeaways here is that it seems like in every single market, the 3-bedroom rents for quite a bit more than the 2, and the difference between the 1 and the 2 is not as great as the difference between the 2 and the 3.
So if you can find a 6-bedroom duplex, they're rare and expect to overpay. Also, if you can find a side-by-side with 2-bedroom units on each side with a split basement where you can add that 3rd bedroom, I mean, that's not even going to exist. When we're doing this podcast 10 years from now, Tim, they'll have all been finished, right? Yeah. And so jump on that because that's where the value add is.
Yeah, I'll just, I have a spreadsheet here. 6-bedroom units, and there were 31 last year in St. Paul, 6-bedroom duplexes that sold in all the submarkets. 31 total.
Yep.
So,
moving on, some St. Paul neighborhoods I have written down. They vary so much from block to block or north of, especially the neighborhoods that straddle 94 and University Avenue. It's almost pointless analyzing a few of these neighborhoods as a whole because they're so different. Summit University would be one of those because part of Summit University is like the 400 block of Holly Avenue or Ashland Avenue, some of the most beautiful Cathedral Hill neighborhoods. And then part of it, I don't want to talk disparagingly, but are just not as nice as certain blocks. And so when you look at the Summit University numbers, when you look at the Merriam Park numbers, which part of Merriam Park feels like Midway, part of it feels like Mac Groveland, I just don't love painting with that broad a brush. And it's also very hard to give it a score, right? Same with Como. You've got around the lake in the northern area, fantastic. South Como, not so much. We gave it a C+, but a lot of those areas really deserve like a B+. Whereas some of these you can really, like Midway as a whole, you can bank on these numbers being relevant. Highland Park, for the most part, relevant. Mac Groveland, relevant. Summit Hill, relevant. So just be wary that, there's certain pockets. We're trying to give you averages, but certain pockets are going to be complete outliers in a lot of these fields.
Yeah.
Anything else about the meetup last night that you want to cover before we move to our next subject?
No, but I will say that we're going to do the same thing for Minneapolis, and we're going to do some version of a suburban one, probably splitting the suburbs up into either 2 or 4 different groups, depending on, once we dig into it and we see what this looks like, we'll determine that. But we're going to do at least 3 more of these, and maybe even up to 5 more of these analysis. So they'll be in podcast form, but we'd love to have you come out and ask questions and give us your input.
Yeah, being in the setting with us really is the best way to do it, because we also show you examples of listings. We kind of picked like a low end, medium, and high end for each neighborhood. Architectural things to look out for, mechanical, structural things to be wary of. If there's one thing that Tim and I can talk about at nauseum is St. Paul and Minneapolis duplexes.
Yeah. So here's something that jumped out to me yesterday, and I guess it shouldn't be a huge surprise, but I noticed this halfway through or late, more through the thing. When you were showing the pictures, nearly every single place had a boiler. Mm-hmm. So if you're looking for forced air, St. Paul isn't your place. And
totally.
if you want forced air and you find one, you better bid on that one. You better make it work, because you're not going to find too many that have AC and stuff. They're going to be forced air and so forth. So I'm sorry, they're going to be boiler.
And I'd say most people are just uneducated on boiler systems, right? Yeah. I mean, I don't have a problem. I guess I'm about 50-50 with what I've owned, boiler versus forced air, but I don't at all have. I think there's a lot of positive to boiler heat. You don't have that air blowing at you, ruining your audio during your podcast. Allergies are better because you don't have to change the filter. I think there's lots of pros.
I lived in a house with a boiler for 19 years. We did zero maintenance, and we had we never had the boiler go out. Mm-hmm. I did actually have some work done in at one point, but it was optional work to, like, let's say, make it more efficient, and I had them tune it up at that point. But in 19 years, I had one tune-up. I have some rental properties where every other year, every third year, I have at least one of the 2 furnaces act up and it needs a repair.
Mm-hmm. Boilers are just simpler machines.
Yeah.
It's some flame and a tank and a pump and a few other components, but that's about it. Whereas a furnace, there's more things that could break.
Yeah.
Okay, so moving on to the next topic, I want to start, I don't know if this would be like a monthly segment or something we do talking about return on equity. We have a lot of clients between the 2 of us, friends, family, who are sitting on some pretty massive equity. A lot of people talk about appreciation and cash flow, but are we really optimizing our return on equity? My dilemma currently, and I'm not going to get into the weeds on it today, is, I've got big chunks of equity in 2 different rental properties, and I feel as though if I want to maximize appreciation, spreading that equity into something else is probably going to be better for my future wealth. And I just thought it would be a cool thing to pitch to our listeners. If you can send us an address, a loan balance, gross net income, and a summary of expenses, and we can keep your information private. We're not going to broadcast your address over the internet. I thought it would be a really cool exercise to help folks optimize their equity, because buying something and then just forgetting about it for 25 years is fine and arguably not a bad way to invest in real estate, but we could all be doing better, getting a better return on the equity we have. What do you think about that?
Yeah, well, a couple of things. One, I think if you look at how rich people get, wealthy people get wealthier, it's they use their money to make money, right? And that's exactly what we're talking about here. So I think it's typically a poor person's mindset to not look at that.
Totally.
Now, don't get me wrong. I had that mindset, and frankly, I came from that place, right? So I understand the concept, but when I look at how Nicole and I grew our portfolio, we're not independently wealthy, and for most of my life, she was most of my working career, family life, she was stay-at-home mom. I made decent money for one person, but for a family, it was not crazy, and we still were able to grow a rental portfolio, and a lot of it had to do with utilizing equity. So I did learn as a lender how to do that, and I think it's very important.
Yeah, and if anyone's sort of confused about this topic, if you've got a paid-off house, and you're sitting, you're sitting on 300,000 and it's great. It cash flows 2,000 a month and it's just gravy. Well, there's a pretty good chance that if you fast forward 10 years, you would do better spreading that, using leverage, spreading that 300 amongst, let's say, 4 single-family homes, sacrificing the short-term income for long-term gain. And that's what I'm currently looking at my portfolio, thinking like I'm a little lopsided in a few ways. How can I be better? And
Yeah, and I mean, I certainly it's a case by case basis, but there's no saying that like if you do spread the equity out that you would necessarily make any less per month. You'd have more work because you'd have more properties potentially, but 4 properties, 4 single families might cash flow just as much as 1 paid off multifamily. Again, hard to say. That's, depends on neighborhoods and things of that nature. But if you're buying right and you're looking for good deals, I would absolutely say they would cash flow the same or more at that point if you're really trying to make that optimize for that.
Definitely. And is the asset that you're currently invested in the best asset long term? Do you think it's going to the moon or perhaps something else could be better? So,
yeah. Well, there's always a repositioning, right? So, even if the asset, like, let's say we had a property, I remember Nicole and I owned it for a year and a half, and we're like, we just don't like managing this property. And most of it had to do, it was in a neighborhood where there was just more transient nature in the area. And, frankly, just everything about it was just a pain in the ass, including it didn't, for whatever reason, it was harder to rent and it didn't attract as many good renters. Credit score, all that stuff, right? And so we decided, after owning it for a short period of time, that was one we would want to sell and reposition that money somewhere else too. So there's reasons other than just, if you're self-managing, sometimes having a place that's easier to manage it's a benefit,
Totally. So this is just a call to our audience. Send us a message on social media, wherever you're listening to us. If you want our 2 cents on your current equity position, again, we need the address. We won't broadcast the address. We need a loan balance, gross and net income, and a summary of your expenses. Let us help you.
Yeah.
Otherwise, the other thing I wanted to plug, my broker, Kirk, who we're going to have on an upcoming podcast, kind of a brilliant guy when it comes to real estate data, has been training us on this sneaky method of, okay, so Tim, I'm your agent, right?
Yep.
And you and your wife fell in love with a home. It's been on the market for 6 days. You say, well, call the agent, see what's going on. And I'm going to call the agent. And what is the agent going to tell me 9 times out of 10? When I ask, hey, what's it look like, showing wise?
I would say they're going to say lots of showings. We're expecting an offer is probably something along those lines. Yeah, something like that.
Exactly.
Maybe even we have an offer, but somewhere along that lines, right? Expecting an offer, I think they'd normally say, because they want to encourage you to make an offer too.
Lots of parties circling, lots of interest.
Yeah.
I'm talking to lots of agents. I'm going to give, most agents the benefit of the doubt that they're not going to tell an outright lie about having an offer when they don't have one. Although some of you, I've caught you doing that shit. But most people don't. But anyways, there is this method of actually finding the property using, Showing Time, which is the software that all agents use with North Star MLS to book showings. And we can actually find the property, especially when inventory is low. This is easier. And we can see how many showings have been on that property. So I just love stuff like this. Think like sneaky little tools that allow me to provide better value for my clients. And as an investor who will be writing offers this winter, I can't wait to use this new method of actually, showing. I don't want to get too far into it, but Showing Time has a function that was designed to benefit people with listings to see what the competition is doing, right? Mm-hmm. If I want to know what the other $350,000 duplexes in the area have showings this week, and then you can go to your client and say, hey, even though we've only had 3 showings this week, that's the market average. Well, what Showing Time probably didn't intend on was giving us so many filters that we could literally just filter to the point where it's just one house.
Yeah, I got
and now we're seeing how many showings they have. So This is kind of huge. If you're in,
Does it break it down by like last 7? So when you sell a house, it'll tell you how many showings in the last 7 days and like maybe the last 2 weeks and the last 30 days, something like that. It breaks it down by time period. Does it do that in this case, or is it just aggregate showings?
no, it's definitely by time period. You can't see day of showings, but I think you can even just see yesterday's showings.
Okay.
So this is stuff that you want to use if you're between like 2 and 10 days on the market.
Got it.
And
Might be useful for flippers too.
in what sense?
Just seeing the activity in the market.
Yeah, totally.
You know? Useful.
Well,
for,
yeah, yeah.
And also pricing your home. Hey, I want to price my home. Here's what the market's saying. Well, let's, it's a slower time of the year. Let's look at how many showings are happening now so we can see if you want to up your showings or if you want to, or, hey, there's not many showings going on right now, so dropping your price super low might not do anything for you. Maybe maybe you need to keep it closer to whatever you think you want, and we're just going to be sitting there a while, right? Like days on market are going to tick off, We could, since when this is going to air, I think this is worth bringing up. You can expect your days on market to increase because of the holidays. You don't need to panic on that issue right
Don't
now.
drop your price just because of it.
Yeah, exactly.
I'm telling that. I mean, folks who don't need to sell should not sell right now, and folks who are in no rush to sell really should not decrease their list price right now. That's just the market we're in.
Yeah.
Otherwise, Tim, you're kind of dealing with a situation right now, huh? Do you want to go? I don't know how much you feel like sharing, but tell the audience. Tim flips a lot of houses. He's a pretty active investor.
Yeah, I think this is a relevant topic for anyone, whether you're an investor or not. But what I'm seeing is, so we have multiple properties that had multiple permitted things, and some of it we did have some things that were not permitted originally but are now. And what I'm seeing across the board and is inspectors who really are pushing for work to be done that wasn't in the exact scope of the permit, and really basically discourages people from doing permitted work. Essentially what I'm saying is they are so hard on you and they force you to do so many extra things that are kind of ridiculous in the grand scheme of things. And that then encourages people to not to try to avoid them, right? And so it's just this general feeling that look, more people would do good quality work and show you, Mr. and Mrs. Government, if you would just simply, narrow your scope to that and maybe what's critical. Here's a good example. We have a property where we've had multiple. So it's what's called a Category 2. Vacant house in St. Paul, close to being condemned is what that means, right? And this thing's been under inspections the whole way. Everything's been permitted and inspected the whole way. We'll get down to the very end after, I can't even tell you how many inspections. And all of a sudden, the last inspection for electrical, they say, oh yeah, you need to do new electrical panels on the inside of the house and new meters on the outside. Oh, and by the way, the meters have to have disconnect. The combination of everything I just said was $20,000. And the disconnect portion alone, part of the meters, that was an extra $5,000. So it was $15,000 without this disconnect.
Now, do you feel like you are being unfairly targeted because you're an investor? Do you think Joe Homeowner?
I think Joe Homer does not get that
completely.
Yes. I think they don't. But I also, above and beyond that, I think the ridiculousness of it is this. If you take the 1,000 homes closest to this, we are probably the only one that'll have a disconnect. And maybe there'll be 3. Or even 5. But it's a meaningless amount that doesn't create real safety. Like, houses are not burning down because, the disconnect's for the fire department, but it's not creating a meaningful thing, but it is creating a meaningful cost. So there's not a meaningful benefit to the community, but there's a meaningful cost. And if you just keep adding these things over and over and over again, 5,000 here, 10,000 there, that is the cost of housing. We can create safe housing that's not this expensive, but we have to change our attitude towards it.
I feel like, the people who generally want a larger government doing more for the people, probably just don't deal with their government on a semi-frequent basis. Am I right?
That's probably true. And I am not saying that inspections shouldn't happen, but it's the adding on of the work, especially the work. Like, okay, here's another thing. My brother is a firefighter in Minneapolis, right? And when he tells me about what causes the most fires, he's not usually bringing up electrical panels.
What does
electrical
cause?
wiring is in there, but it's like it's like kitchen slash kitchen fires in general, and smoking are two of the top ones. Okay. Actually, I think even above and beyond that, if I'm not mistaken, is poor quality extension cords, plugging things that shouldn't go into extension cords, like a window air conditioner plugged into an extension cord is a big no-no. A big no-no. You want to cause a fire, that's a great way to do it, right?
Interesting. Didn't know that.
But, like houses burning down because of bad wiring is absolutely in the cards, but it's a low mark. Now we have to kind of look at, is it really because of the fuse box, or is it because the wires are, like knob and tube, right? I'm speculating here. I'm guessing it's the knob and tube side and not necessarily the old panel, because I've heard so many different inspectors tell us about these bad panels, and I'm just not seeing housing fires because of panels or hearing about it very often. I'll get some I want to get some stats on this and bring it to another podcast, because I just think we can go, okay, how, are we talking less than 1% chance of fire? Are we talking less than 0.5% chance of fire? Like what is the realistic thing here? Do we need to have this person spend $15,000? Is there a real benefit?
Well, and I would say too, we can all agree that Tim and I are probably not the best suited to decide what safety decisions need to be made in general.
Yeah.
But we can all agree that like what drives people crazy is the inconsistency. Be consistent and be upfront. So like if Tim is buying a house as an investor, he can say, oh, the city's going to make me do this. But right now, it's a roll of a die. You might get the guy who's totally fine with a 6-foot soffit in the middle of the basement. Sure. Or you might get the guy that says everything's got to be 6'4", and I'm just hoping that I get the cool guy. Yeah. And it's just insane.
Yeah. Because guess what? Not everyone will rent a place that has a 6-foot ceiling, but some people will, and they'll appreciate the slightly lower price, right?
Totally.
And they need the housing.
Yeah.
No, you're right. I don't know where, I definitely don't know where the cutoff is, but I know there is one. And to your point, they could say every X, I don't even know the brand, but let's say every panel brand X built between these years upon inspection needs to be replaced. If that was published somewhere and that was the rule, and if it wasn't panel X and it wasn't built between these years, it's good to go. At least you make decisions based on that, right? We might have like real data. Well, panel X's statistics are pretty poor, right? There is a 1 in 100 chance of this one starting on fire, as opposed to 1 in 0.01% or something like that.
The Federal Pacific was always the one I was taught to avoid. And then inspectors are so funny, because they'll be like, well, here's the problem. And then here's why it's not a problem. But, he'd always say, yeah, Federal Pacific, fire hazard. My boss has a Federal Pacific in his house.
And he didn't change it out,
And he didn't change it.
And he's an inspector.
who owns a very prevalent inspecting company. So, I don't know, man. I hope that you get out of the weeds.
Yeah.
Because,
All right. I think that's it. Please download the podcast. Please share this with your friends. If you download it, that tracks, like, more people are going to see it if you share it, you download it, you subscribe to it. So please do all three. We really appreciate it.
And write a review if you can.
Yeah.
If you have any comments, questions, concerns, you can find Tim and I all over the interweb. And until next time, thank you so much for watching. We love you guys.
That's it for today's show. You can visit the Twin Cities Real Estate Investing.com website for show notes, tips, tricks, and other local real estate investing information. Adam and Tim would like to meet with you. To schedule a one-on-one meeting with either Adam or Tim, go to TwinCitiesRealEstateInvesting.com/schedule.